Good morning, good afternoon, and good night. My name is Bert Budgets, and you're watching Channel 7 News. The top stories we'll be chasing tonight. The baby dancing video that goes viral. Missing Canadian gnomes spotted all around the world. Secrets from the fire community. How to invest your money for future success. Now, over to our finance expert, Norbert KALLAI. What's going on, you guys? My name is Norbert KALLAI, and welcome to another edition of Finance Fridays. Before I start today's episode, I just want to take a second to send a shout out to everyone that's watching that's been sending me love and support so far. I really appreciate it. This is the exact reason that I started this channel. In order to grow wealth, we need to ensure that we're putting our money into assets, or things that are making us money, as opposed to liabilities, things that are costing us money. Common assets include investment securities, such as stocks, bonds, mutual funds, real estate, and starting your very own small business. In today's episode, we're going to be covering the 4 most common investment security vehicles that you can purchase. As well, at the end of this episode, I'll tell you my personal recommendation on how you should be investing. Stocks. Plain and simple, a stock is a part ownership in a company. When a company IPOs, what they do is they make portions of their company available for the public to purchase. They do this in order to gain more capital to grow the business. Once you buy a stock, you essentially own one portion of that company. You are a part owner. If the company does well, then you do well. If the company does poorly, then you do poorly. The upside of stocks is that you have a high potential to make a lot of money. If you invest in a small startup company or get in at the right time and the company grows significantly, then your small portion will also grow significantly. But the big con of stocks is that you also have a huge potential to lose money. Most people that buy stocks, myself included, are essentially gambling. We're speculating on what's going to happen with these companies. When I first started investing, I bought a lot of stocks. I didn't take the time to read quarterly earning reports, listen to the calls, and do the research required to make an educated decision. Essentially, I was just throwing money at businesses and hoping they did well. Just like gambling, remember, you win some, you lose some. An example from my own life when it comes to stocks is during the Cambridge Analytica scandal, Facebook stock dropped by over 20% in a single day. But when you looked at the actual data, user base was going up in Europe, remained flat in North America. As well, Facebook had just purchased Instagram, which was on the rise. A 20% drop in the Facebook stock did not make sense just because of the poor media. I invested $5,000 into Facebook, and over the coming months, it not only recovered, but ended up growing past that 20% decrease. Although I've had many successes with stocks, including Facebook, Amazon, and marijuana, I've had more failures. Because I'm not willing to put in the time and research required, I was essentially just gambling. By investing in certain companies like GoPro, Canadian Uranium, and others, in total, during my years of managing my own stocks, I actually lost $7,000. Bonds can be seen as IOUs. You lend someone money with the intention they're going to pay you back. When you purchase a bond, most of the time these are connected to governments. The government will issue a bond with a maturity date, normally 5, 10, 15 years. As well, there's an interest rate associated with that bond. What you are actually doing is loaning the government money for a predetermined amount of time with the understanding that not only are they going to pay you back, but they're also going to give you a little bit of interest just for the sheer benefit of letting them use your cash. You are acting as the bank. The pros of bonds is that they are safe. Because you're issuing the loan to a government, a large establishment, you can pretty much guarantee they're going to give you your money back. Well, guaranteed. We all know what happened in Greece. The big con with bonds is because they are so safe, the interest that you can expect to get is very low, normally 2 to 3%. Bonds are a very good hedge against inflation. Because inflation averages 2 to 3%, by investing in bonds, you can guarantee that your money will keep up in the same value that it's depreciating with inflation. Another big con with bonds is they are contractual, meaning that there's a maturity date attached to the bond. If you decide to remove your money too early, you could be penalized. Typically, financial advisors will tell you that the amount of bonds you own in your portfolio should equal your age. For instance, me being 31 years old, I should have 31% of my portfolio invested in bonds. However, this safety and low risk also equals low return. So to have that much percentage of bonds in your portfolio is actually detrimental to the opportunity cost that you're foregoing when in compared to the returns you can get in the stock market. Because I know that my investment horizon is several decades, I don't necessarily invest into bonds right now. The reason for this is because bonds are so low risk and safe, they don't really offer the potential for my money to grow. In the book, The Simple Path to Wealth, author J.L. Collins talks about two different seasons in your investing life: the wealth accumulation phase and the wealth preservation phase. During your wealth accumulation phase, you should be heavily invested into stocks as they provide a bigger return. In your wealth preservation stage, closer to retirement or in retirement, your portfolio should include more bonds. As you're trying to maintain the wealth, I highly recommend that you diversify your portfolio with bonds according to your risk tolerance. If you're not going to be able to sleep at night if your portfolio drops 30%, then you shouldn't be 100% invested into stocks. Because picking the right stocks is very risky, and also just investing into bonds is too safe, what do? Normally, banks will push mutual funds on investors. What a mutual fund is a pre-made portfolio. You're buying one mutual fund, but that mutual fund is comprised of several different stocks, bonds, and asset classes. Mutual funds offer great diversification. It is very dangerous to put all of your eggs in one basket. Depending on your risk tolerance, the mutual fund will lean more towards stocks or more towards bonds. A high-risk mutual fund will have a greater percentage invested into the stock market. A low-risk mutual fund will have a bigger portion allocated to bonds. The pros with mutual funds? They're diversifying your risk, not putting all of your eggs in one basket or any one business. There's less research required on your part. Instead of looking into a bunch of different companies, listening to a bunch of conference calls, and researching which companies you think will be successful in the future, you can just buy that one mutual fund and diversify your risk among several different companies. And the reason the average Canadian likes mutual funds is they're easy. You walk into a bank, you pick your risk tolerance, and essentially put all your money into that one mutual fund. However, the huge con when it comes to mutual fund is the fees. Because mutual funds are actively managed, meaning there's someone in charge of buying and selling the assets inside of that mutual fund, there's an associated fee. Normally this fee ranges between 1% and 3%, which might not seem that big when you're thinking about a test score, but when it comes to your investments, 1% to 3% could mean the difference between being poor and being wealthy in retirement. Most of the time, these fees are cleverly hidden inside the funds. When looking at these funds, you want to look up to see what the MER is, or the management expense ratio. This will give you an idea of how much this fund is costing you. In my first couple of years of investing, I put all my money into mutual funds with an advisor. Not only did the advisor come with a fee, but so did the mutual funds. These fees ate away my returns, and they did not even keep up with the market average. When you walk into a bank, the person behind the counter is going to push mutual funds on you very aggressively. The reason for this is their pre-packaged mutual funds benefit the banks, not you. Be very, very cautious when you're buying mutual funds, as the hidden fees can kill your wealth. And my favorite, low-cost index funds. So what is an index? An index is a snapshot of a market to see how well the market is doing. You probably heard terms like the NASDAQ, the Dow Jones, and the S&P 500. These indexes give you a snapshot to see how well the American economy is doing. The reason low-cost index funds are such a great vehicle to invest in is because unlike mutual funds that try and beat the market average, but over 90% of the time fail, low-cost index funds capture the market average. On average, since inception, the stock market has returned 7 to 10% annually. Because low-cost index funds are a snapshot of the market and they are not actively managed, the fees associated with these funds are very low. When compared to mutual funds that are typically 1 to 3%, most low-cost index funds and ETFs operate at around 0.3%. This is a massive difference when you're thinking about investing over a 25-year horizon. A great example here is instead of investing just into, say, Apple stock and putting all of your eggs in one basket, you can buy the S&P 500 index. The S&P 500 index not only includes Apple, but big companies such as Amazon, Netflix, Visa, Nike, McDonald's, and 500 of the biggest companies in the United States. You can own all of these companies in one fund for a very, very low fee. The pros with low-cost index funds include diversification. You're diversifying your risk amongst hundreds of different companies. The huge benefit is their low operating cost, less than 1%. Sometimes they're less than a fraction of a percent. Instead of trying to beat the market, which most investors typically can't do, you're just capturing the average market returns. The cons? They're not very sexy, and they're at the mercy of the market. Yes, some years the market will go up, but some years the market will go down. Such as right now with the COVID-19. The markets as a whole have gone down roughly 30%. So you're going to have to stomach and weather this storm to get to the other side. On a long enough timeline, the average return is 7%. They're not like stocks where you can get 100% return in a week. No, we're trying to capture the market average. Remember, we're not trying to get rich fast, we're trying to get rich for reals. Another huge con is due to the popularity of low-cost index funds, there's been a lot of ETFs that have started to pop up. Not all low-cost index funds are created equal, so you have to make sure that you're buying the right ones and not these imposters that are disguising themselves as low-cost index funds. My recommendation, if you're going to invest into stocks and try and gamble on certain companies, try and minimize this to 5 to 10% of your portfolio. When it comes to bonds, try and match up the percentage in your portfolio with your risk tolerance. If you're not going to be able to sleep at night if you lose 50% of your portfolio in a drop in the stock market, then you shouldn't be 100% invested into equities such as stocks. If you're decades away from your retirement, I would try and minimize the percentage of bonds in your portfolio to no more than 30%. Remember, we're in the wealth accumulation stage of our life. As you get closer and closer to retirement or the wealth preservation stage of your life, you should try and increase the amount of bonds in your portfolio. Currently, I am 100% into stocks and 0% into bonds. I'm trading high risk for high returns, but I have time on my side. When it comes to mutual funds, my recommendation is going to be completely biased. Do not go to your bank and buy the mutual funds that they're suggesting. Chances are they're pushing you into something that's going to benefit them, not you. And be very, very cautious of the fees you're paying for. Don't take my word for it. Educate yourself. Read books, blogs, listen to podcasts, and watch YouTube videos. I've done this now for several years, and when you continuously hear the same message over and over again, it's very easy to see why I invest into low-cost index funds. Now that we know that low-cost index funds are the best way to grow our wealth, on the next episode, I'll tell you exactly which funds I'm invested in and why. All this and more next time on Finance Fridays. Very interesting stuff, Norbert. Now, over to Emma Rose with the weather.